Office landlords are defaulting at a record 12.34% right now.
1 in 8 loans, and every headline is screaming about a $1 trillion CMBS wall hitting in 2026.
That number's wrong. The real hard maturity figure is $76.6 billion.
Welcome to the Trade Room.
I'm Blake.
I'm August, and today we're taking apart the maturity wall story everybody thinks they already know.
Right. The version going around, office is dead, CMBS is about to blow up, and it all lands at once in 2026.
Clean story, except the math behind it is a lot messier.
We'll walk through how that $76.6 billion actually breaks down and where the real refinancing pressure sits.
We're also using one loan, $835 million, one building in Manhattan, as a live case study for how these workouts actually play out.
And we go inside a special services process too. New transfers just hit the desk this spring.
Later, a Texas multifamily portfolio lands in special servicing after losing a tax exemption.
Which makes you wonder, is multifamily catching the same debt yield scrutiny office has been getting?
Save it, Blake. We'll get there.
Fair enough.
We'll close with an accountability round. Who missed this and what they'd fix at origination today?
Let's start with that 12.34% number and why the $1 trillion framing everyone's using is off.
12.34%. That's office CMBS delinquency in January, and Tripp's been tracking this since 2000. Never been higher.
Oof, higher than '08?
By about 1.5 points. Tripp's data shows that this year.
Wait, we just beat the financial crisis peak and I didn't see that on a single front page.
Because everyone was chasing a different number, the $1 trillion wall.
Right, that's the headline. Trillion plus in commercial mortgages coming due, sectors about to fall off a cliff.
Except that's not the 2026 hard maturity number. Cred Daily's review puts actual hard CMBS maturities this year at $76.6 billion.
76 billion, not trillion.
Not trillion. Office and retail carry the biggest chunk of that exposure, according to Cred Daily.
So the scary round number everyone's quoting is just the wrong one?
It's the wrong sized one, and treating it as one big cliff misses the actual story, which is loan by loan.
Debt yield, refinance risk, extensions, masking distress.
All of it gets flattened into one scary headline number, and most coverage skip the math entirely.
Okay, so if it's not a trillion and it's not one cliff,
what is actually maturing, and how much of it is already broken before it even hits the wall?
Building on that 8-point-something% debt yield number, let's actually break the $76.6 billion down loan by loan.
right, and it's bigger than that headline number too. Cred Daily notes the hard maturities are $76.6 billion, but once you add the floating rate loans that can still get extended, the full 2026 calendar runs to $146.2 billion.
Nearly double.
Nearly double. Extensions just push the reckoning. They don't erase it.
So walk me through the piece that actually worries you, the debt yield split.
About $27.3 billion, 36% of the hard maturities, sits on loans with a debt yield at or below 8%.
Okay, for anyone who hasn't underwritten a loan, what does that actually mean in dollars?
Say a building throws off $800,000 a year in net operating income. If the loan balance is $10 million, that's an 8% debt yield. Lenders use that as the floor for a clean refinance.
And below the floor?
Below it, the lender looks at that same $800,000 and says, at current rates, I can't size a loan this big against that income. Something has to close the gap.
So the borrower's choice is...
fresh equity in, a paydown to shrink the balance, or hand the keys to a special servicer and let them sort it out.
That's not a refinance conversation anymore. That's a capital structure crisis.
Exactly, and it's not evenly spread through the year either.
How lopsided are we talking?
Nearly 39% of the whole hard maturity total lands in the fourth quarter alone.
Wait, so most of 2026 hasn't even shown its hand yet?
That's the read. Trepp's data shows the real test is still 5-6 months out from where we're sitting.
Which means every delinquency number we've quoted so far is a floor, not a ceiling.
Could be. Depends how much refinancing gets done before Q4 hits.
$27 billion under the debt yield line, 39% still sitting in Q4. That's a lot of loans waiting on decisions nobody's made yet.
And nowhere does that low debt yield math show up cleaner than office, one loan in particular.
Go on.
$835 million. One building, one very tense conversation with a special servicer.
Case in point, One New York Plaza, $835 million loan, Brookfield's tower down in the financial district.
Transferred to special servicing right ahead of its January maturity.
Never once delinquent either. Straight balloon default risk, not a payment problem.
So they modify. New maturity January 2028. Trims the principal, adds a leasing reserve.
2 years bought. Is that solving anything or just moving the cliff?
Depends on what office rents do between now and then. Nothing changes, you're back here.
That's interesting, because the headline number everyone quotes
Doesn't even agree with itself. KBRA's January read put office CMBS delinquency at 13.9%, up 156 basis points in 1 month.
Wait, higher than the 12.34% we opened the show with?
Same month, different rated pool. KBRA and TREP just aren't measuring the same universe.
So which one's right?
Neither's wrong. That's the trap. People quote one number like it's the number.
And none of this is contained to bonds.
No. Credaley reports banks hold roughly $1.89 trillion in income-producing CRE loans. Securitized lenders hold another $753 billion.
Quoted trillions after a back from commercial, CMBS is actually the smaller slice.
Considerably smaller. Banks just don't
Right.
report delinquency on the same clock, so it stays quieter longer.
Trev's word for all this extending, Credaley quoted it as a path-dependent sorting process,
Meaning weak sponsors don't vanish, they get pushed further down the line.
which is exactly what happened at One New York Plaza.
We'll see if it happens again in 2028.
Or if the desk handling the next one looks messier than this.
Speaking of that desk, we've got someone who actually sits at it.
Building on that, let's get inside the servicer's desk. What actually happens when that sub-8% loan lands there?
Servicers describe it as triage, not liquidation. First move, pull the debt yield, the rent roll, the sponsor's cash position.
And decide what? Cure it or write it down?
Exactly that split, and most get labeled cure candidates first.
Of course they do.
CRE Daily reported the special servicing rate actually fell to 10.86% in May.
Fell? After everything we just walked through in office?
Cures and modifications outpaced new defaults that month, but $2.9 billion in new loans still transferred into servicing that same May.
So the pile's shrinking on one side while it's still filling on the other.
That's the tension nobody puts in the headline.
Okay. Recovery math. Distressed office paper, sub-8% debt yield. What comes back?
Roughly a third gets recovered through workout. Fresh capital, partial paydown, extension. The rest gets written down against the trust.
That's a rough split services describe, not an audited number. I want that on the record.
Fair, directional, not a filing.
Here's a phrase I keep hearing, almost word for word. We're managing an orderly resolution. What does that mean in actual dollars?
Extend the maturity, defer some interest, push the performance test out 18 months.
So, orderly resolution is extend and pretend with a nicer name.
I wouldn't put it that bluntly on their behalf, but
I will, because Credaley reports extensions are masking immediate distress, not resolving it.
they also flagged that worsening post-maturity could pressure delinquency later this year. The wall doesn't vanish, it moves.
To 2027, 2028.
Right where the One New York Plaza extension just landed.
So the servicer isn't fixing the sub-8% problem, they're financing time on it.
Buying time costs somebody. Question is whether it's the equity holder now or the bondholder later.
Quietly. And nobody said out loud who eats that yet.
Not yet.
From the servicer's chair to the lender's chair, then.
Because eventually somebody has to choose, extend again, take equity, or force the sale.
Shifting to the lender's side of the ledger, because the sponsor doesn't get to decide this alone.
There's a proceeds gap, and the lender has three options.
Fresh equity, partial paydown, or walk. So why write a bigger check for a sponsor who's already short?
Why does a lender ever take that risk instead of forcing the paydown outright?
Because the sponsor's operating history is still clean. If the asset's cash flowing and the shortfall is proceeds, not performance, the lender's betting on the manager, not bailing out a broken deal.
Okay, but why not force the paydown every single time then? Take the guesswork out. Because most sponsors don't have that liquidity sitting around. Force it and you don't get a paydown. You get a maturity default and a workout file.
And why would a lender ever accept fresh equity from someone already underwater?
Because replacing the borrower costs more than trusting them. New sponsor, new diligence, months of lost time on a distressed asset.
There's a live version of this playing out in Texas right now.
Go on.
A 318-unit portfolio in Waco and Denton, Nitya Capital's Swapnil Agrawal just went into special servicing. Multifamily Dive and Morningstar Credit reported the borrower couldn't lock in a property tax exemption after a Texas law closed the loophole.
Wait, the exemption disappearing broke the deal?
The loan required a 10.33% debt yield if the exemption failed. It failed. Now Agrawal owes the lender, Argentic Real Estate Finance, a paydown to get back to that hurdle.
So a state legislature basically underwrote the refinance math.
Legal risk,
Wow.
tax risk, refinance risk, same spreadsheet.
And that's multifamily, the sector everyone called insulated.
Which is exactly the question. Morningstar DBRS put out a January estimate. More than half of the roughly $100 billion in securitized mortgages coming due this year won't pay off at maturity. Payoff rates were above 80% back in 2023.
That's not an office number. That's the whole market.
So is multifamily quietly landing on the same low debt yield watch list as office?
Ask the borrower in Waco. He didn't see a leasing problem coming. He saw a legislature.
Which means the underwriting failure might not even be about the property.
And that's the part worth putting on oath. Who actually priced that risk into the loan back when it closed? Shifting to accountability, 2016 and 2021 vintages. What actually went wrong in underwriting?
Both cohorts got priced off cap rate compression lenders treated as permanent. Debt yields only cleared 8% because rates sat near zero.
So refinance risk never got priced into the loan at all.
Right. Nobody stress tested a 500 basis point rate move into the exit.
Who should have caught that? Rating agencies signed off on these pools.
Agencies, originators, and sponsors who knew the debt yield was thin and bet on rates staying low anyway.
A-Invest numbers back that up. $57.7 billion of this year's wall is projected to default right at maturity, more than half.
That's not a surprise. That's a pricing failure baked in years ago.
If you're running the underwriting back today, what changes?
Stress the debt yield at a higher cap rate on day one, origination, not exit. If it doesn't clear 8% under stress, you don't make the loan.
Mine, shorter terms, mandatory rate hedges, no 5-year bullet loans betting on a refinance market that might not exist.
Right.
Cheaper than a special servicing file in 2026.
Hindsight is a hell of an underwriter. So if you remember one thing from today,
It's that the $1 trillion maturity wall headline everyone quoted was just wrong.
Credit's number is $76.6 billion in hard maturities. That's the real 2026 figure.
And the debt yield walkthrough stuck with me. $800,000 in NOI tells you more than any round headline number.
Exactly. Watch the debt yield, not the scary number.
And that accountability round, everyone naming their fix from 2016 and 2021.
Underwriting mistakes get made in good times, not bad ones.
New episode drops every Tuesday.
Subscribe wherever you're listening, and if this one changed your mind about something.
Send it to whoever was wrong about it.
Exactly.
Thanks for spending the time with us.
See you next week.